Hi everyone, today I'm going to discuss with you guys with the chapter 12, accounting for depreciation and disposal for non-current asset. So basically this chapter we more concerned about the non-current asset. So such as the computer that you're using in the company, you bought it in 2022. So this year is 2024. In between there is 2 years of usage. So this period usage of this product, this computer equipments, it might cause the value of the computers reduce compared to the first day I purchased in year 2022 because of the second-hand value. So therefore, my market value of this non-current asset will change. So our job is to calculate how much that they already depreciated of the value. This topic will concern about the introduction, accounting principle that apply to the depreciation, and also methods of calculating for the depreciation, rate of depreciation, which is only applied in the straight line method. Also, there is a ledger entry, T account for the asset account, and a provision for depreciation. And the last one is when there is a disposal of non-current asset. Disposal means that sale of the NCA. But that one I will discuss detail in the class because they need a lot of guideline for the double entry. Okay, introduction of the depreciation. As I said, depreciation is the decreased value of the non-current asset. So depreciation is an estimated losses from in the value of the non-current asset over the expected working life. So if you already use it for your car like second-hand value, let's say you already use up the car for drive for 10 years. Do you think people were willing to buy from you at the cost price that you initially that you bought in 10 years ago? They will not pay the same amount because the car already used. So once you use, and according to years, the more that you use, the longer time that you using, then the lower the value of the non-current asset. If the accounting continues to show the purchase asset at their cost price, the accounts will provide misleading information. Means that if you keep on recording the same cost price as your non-current asset in your SOMP, so it will show a misleading information because the car that you are driving now is no longer worth as the first the day one that you purchase. Okay, all right, so the third one, therefore it is necessary to record the estimated loss value. The records can only show estimated of the loss for the non-current asset because of the depreciation. The exact amount will only be known when the asset is disposed or sold. So how much its value or how much it gain or losses, it will only know when you dispose the non-current asset. The purchase of the non-current asset is capital expenditure. Capital expenditure in chapter 10 we already mentioned. When you purchase non-current asset, we call it capital expenditure. If you sell it and you receive money, then we call it capital revenue. Okay. Accounting principle that apply for the depreciation, which is two of them, matching principle, prudence principle. The matching principle and prudent principle we already done in chapter 10. So matching concept is to revenue of the accounting periods match against the cost of the same period. Means that if you record your sales or your commission received for 12 months figure, means that within the accounting period, not accrual, not prepayment, and your expenses must be recorded accordingly with 12 months period as well. So once you compare, then the profit for the year will be more true and fair view. So number two, Matching the capital's expenditure against the sales it has helped the business to earn is done by annual charge of depreciation. So everything that you already sell out from your dispose from your non-current asset, you must deduct it out, and the value will be reduced by the depreciation. So the cost of the non-current asset is spread over the years which benefit from the use of the asset. Okay, they are the cost will reduce by how many years that you already use up. Okay, prudence principle. The prudence concept is to make sure the asset and income are not overstated and the liability not understated. So to make sure your NCA is not only record the value from the day one that you purchase, but it is according to how long that you already use and the estimated second-hand value by now. So every year you need to calculate once until the year that you dispose out. So the depreciation for the year is included in the expenses in the income statement. So the profit for the year is not overstated. You must show and included the depreciated value into your income statement under the expenses to get a more accurate profit for the year. So because this is your losses, it will no longer same value as the price that you purchase in day one. So the principle also apply in the statement of financial position as the non-current asset recorded at the figure less than the cost price, which we call it net book value. Net book value means it's your second-hand value of the current